What about pushing the assumptions behind these inflation forecasts? Well, the release of the 3.2% figure just before the MPC meeting was definitely the catalyst for this rate cut. However, a robust proponomics analysis requires us to look beyond the headline number and interrogate the forecasting failures that preceded it. So, the forecast for inflation in November, the figure that came out last week, was CPI to land between 3.4 and 3.6%. The print of 3.2 was a significant deviation for a near-term forecast. So why were they wrong? Well, the forecasting models appear to have systematically underestimated the speed of disinflation in the goods sector. The China shock, the export of deflation from the Chinese manufacturing sector due to overcapacity, has driven down the price of tradable goods faster than Western central bank models anticipated. Furthermore, the models rely on linear assumptions about the pass-through of lower input costs to consumer prices. But in reality, retailers facing a collapse in consumer confidence and sales volumes, evidenced by the GDP contraction, have been forced to pass on cost reductions faster to maintain volume, therefore compressing their margins. Bit of a panic price drop in November. And of course, that all culminates in Black Friday. But the composition of the fall, well, food inflation fell from 4.9 to 4.2, a supply side correction. Core goods inflation collapsing towards zero or even deflation, and base effects continuing to wash out in the energy markets.